The stock market has been one of the great engines of wealth creation in the United States. It's a core part of many investors' portfolios, yet, if entered into without considering risks, investing in the stock market can potentially have adverse consequences. I'm Scott Connor, a 30-year veteran trader, and today you'll learn about stock investing risks right here on Virtual Trade. Welcome to Virtual Trade. In this episode, we're going to walk through some risks associated with stocks and how to manage those risks. We'll examine how to assess current market trends and explore sectors. Finally, new trader Jenny Horne and I will further evaluate her portfolio. So take your seats, grab your notebooks, because it's time to investigate stock market risk. Whether you're new to stock investing or a seasoned pro, one of the most important aspects to consider is risk. There are some risks associated with stocks and several strategies investors might use to manage them. One of the primary investing risks is directional market risk. This risk stems from the correlative nature of the stock market. Simply put, many stocks tend to move together to some degree. So market risk is the risk that the overall stock market could trend lower, putting downward pressure on any stocks that you may own. When investing in the stock market, think about being a homeowner and the different events that can pose a risk to the value of your home. First, things could break inside of your house, such as plumbing, heating, appliances. Now think about the internals of a stock. We call those fundamentals. Now outside of the house, the neighborhood could, for example, have an increasing crime rate. That would potentially bring down the home values in that area. Think in terms of sectors the same way for stocks. Now in the larger picture, what if the nation's housing market went into a tailspin, just like it did in 2008? This would be similar to an overall market sell-off. Now, let's take a closer look at some of the risks stock investors should be aware of.
One way to monitor market risk is by watching the trend in a broad stock market index, such as the S&P 500. Keeping an eye on the trend can help you make strategic decisions if the market seems to be entering a new uptrend or downtrend. For example, if the S&P 500 begins downtrending, some investors might reduce market risk by selling stocks and moving proceeds into cash until the index starts a new uptrend. In addition to market risk, stock investors need to consider sector risk. This is the risk of bad news affecting an entire sector and impacting many of the companies within that sector. For example, suppose new legislation restricts energy consumption. This news could hurt many businesses in the energy sector, decreasing stock prices. One way to help manage this risk is to diversify across a wide range of sectors. This way, if bad news impacts one sector, only a portion of your stock investments would suffer. The last stock investing risk we'll discuss is business or company risk. This risk encompasses all the risks that come with investing in an individual stock, such as disappointing earnings or sales, a change in leadership, emerging competition, or new regulations. The most dangerous form of company risk is bankruptcy risk. This is because if a company goes bankrupt, its stock will lose all its value.
So to recap, market risk is the risk that a downward move in the overall market could decrease the value of your stocks in general. Sector risk is the risk that bad news in a sector of the market may negatively impact your stocks in that sector. And company risk is the risk specific to the company itself, such as poor earnings announcements or perhaps a change in management. Now, it's time to identify how stock investors can manage risk.
One way to help manage company risk, including bankruptcy risk, is to carefully position size. A position size is the dollar amount invested in a stock relative to the size of your overall portfolio. For example, an investor might use a trading rule that prohibits her from investing more than 5% of her portfolio in a single stock. To give you an idea of what this looks like, let's assume this investor has a portfolio of $100,000 and wants to invest in stock XYZ. To manage her risk, this investor would limit her purchase to 5% of her entire portfolio, or $5,000. XYZ is trading at $50, so she can buy 100 shares. Next, she uses stop orders on this position to potentially limit her losses. Let's say she's willing to lose no more than 1% of her total portfolio, or $1,000 on any one position. She could set a stop at $40. This is a loss of $10 per share, or $1,000 for the whole position. Ideally, if the position plummets, the stop order would trigger and likely help reduce her losses to 1% of her portfolio, a relatively small and manageable setback. Using strategies such as monitoring the trend of the broader stock market, diversifying across sectors, and limiting position size are just a few ways to manage the risks of stock investing.
As we wrap up, it's important to remember there are different types of risk that can impact your stocks. Market risk, sector risk, and company risk can negatively affect your portfolio. Monitoring stock market trends, sector diversification, and proper position sizing are ways to potentially counter stock market risk. Welcome back. It's time for Tools of the Trade, where we look at various tools within TD Ameritrade, thinkorswim, and Mobile Trader. In this segment, we'll be using the tdameritrade.com website to look at the markets and sector trends. Now, in previous shows, we've diversified and talked about diversifying a portfolio, position sizing, and stop orders, all of which are ways to address risk. In this segment, we'll look at identifying the stock market trend in general, along with strengthening and weakening sectors as a part of that market. So let's get started by jumping into the tdameritrade.com website. We'll go ahead and log in with the same username and password that we used on the thinkorswim platform, and let's dive right in. So we're on the opening page once we're logged in, and I'm going to the symbol box, as you can see, and what we're going to start off is looking at the market in general. Now, we talked about the four major indices: S&P 500, Dow, Russell, and the NASDAQ. Today we'll be focusing on the S&P 500. Oftentimes, the index, which is referred to as the benchmark for the overall stock market. So let's put in the symbol for that, SPX, put in capital letters, SPX. And as you can see, we'll just go ahead and click on search and see what comes up from those. And you can see that the symbol, it changed to $SPX.X. Now, this is important. Sometimes the symbol you'll see on thinkorswim is slightly different than the symbol being used on the tdameritrade.com website. This is particularly when you come to indices. Individual stocks, the same. There's no worry there. But sometimes you'll see that. But it will still search the the symbol for you and go ahead and put it in there. All right, so we're on the S&P 500, and you can see that right up here by verifying the title going along with $SPX.X. And you can see a chart down below. So let's start off here by looking at the 1 year time frame of the SPX to get an idea of what the stock is doing. Now, you can see that the trend line, or the point where the market was a year ago to where it is now, is obviously higher. So we could just surmise quickly by looking at this chart that yes, 52 weeks ago till now, the trend has been higher. So the market is on what we would call an uptrend. Now let's take a look at some different time frames. This is a 1 year time frame that we're looking at. We can go ahead and change that all the way out to 20 years to get a long-term view of what the market is doing. And you can see going all the way back to 1999. Here's the sell-off in 2008. And of course, you can see what the market has been doing since then. So it just gives you an idea of the overall long-term trend of the S&P 500. So now that we've established that trend, let's talk about putting potential comparisons and or studies on top of the market to get a little bit more idea about its direction, if we could. What we're going to do is start off with simple moving average, and you can see that we have right now, by clicking on this box, you'll have simple moving average. And right now, you're able to put in whatever you'd like. You can put up to 3 of those, as a matter of fact. Right now, we're looking at one simple moving average with a 30-day period. But oftentimes, people will use 2 different moving averages to get a better idea of what the market's doing in general. All right, so let's take a quick look at how we would do that. Let's say we want to take how about a 50-day moving average, and maybe compare that to a longer term or a 200-day moving average. And we'll hit that update there, and we'll put this on a 1 year chart just to get an idea of what we're seeing. So now you can see that the green line, which is the 50-day moving average, And the blue line, which is a much longer term average, and you can see the difference between the two. The longer average, the blue line, is much smoother because, again, it's taking an average over a much longer period of time. And when you do that, you tend to get less of the sort of the noise in between, the volatility that you'd see on a day-to-day basis. So this is another way of looking at a longer term versus a mid-term moving average. Now there's also other kinds of uses for the simple moving averages. Let's just go to one moving average and bring that down to about a 30-day moving average. How will we do that? Well, quite simply, just clicking on the box here. We'll back out our 200-day moving average and reduce the first line to 30 days. So now we are looking at just a 30-day simple moving average. Now, one of the things that we've identified that the market is in an uptrend. People oftentimes like to use technical analysis or charting with studies like we're doing here to sort of get a little bit more idea of which way the market might be moving within those time frames. So one of the things that people will consider is market direction and something like a short to mid-term simple moving average like 30. So let's take a quick look. For example, you can see that when the market's moving up and staying above this simple moving average, that is a typical bullish type trend associated. What happens when the market breaks below the 30-day moving average? Well, oftentimes people will use that, or technicians will use that as a sort of a warning sign, as a potential change in direction. Particularly when they see both the downward movement on the market and a downward movement on the simple moving average. That is something they tend to follow very closely because that could potentially mean that there has been a shift in the direction. Likewise, if you see the simple moving average start to move up here, like we did at this particular time on this chart, and at the market moved above the simple moving average, again, that's a signal or reversal of the downward move to potential new upward move in the market. So you can see how using these two charts and moving averages in tandem can help give a little bit better idea. All right, so let's take a quick look at sectors within a market that we've talked about the direction and kind of got a little more information on that. I'll start off by moving my mouse over research and ideas and go down to sectors and industries. Now, once I'm on sectors and industries, now we can see exactly what the different sectors are and how they have been performing vis-a-vis each other over different time frames. So let's take a quick look here at scroll in and we'll take a quick look on a 1 day. Now, this is a very short term. So on this particular day, we can see which sectors are outperforming and which sectors are underperforming or down on the day. On this particular day, you can see energy, information technology, consumer discretionary, those are leading the way, but a little bit heavy on this particular day, healthcare, telecom, and consumer staples. Not quite as strong today. Now let's change that time frame from a 1 day, and let's go out with how about 5 years? Let's get a much longer look at the different sectors and see how they've been performing over that period. Now over 5 years, you can see compared to the S&P 500, information technology is leading the way. That's the first one, and followed by consumer discretionary, and then third, industrials and healthcare. On the other side of the coin, if you go down below, you can see telecommunications, energy, and real estate have been the sort of the three laggards over a 5-year time. Now, what you're starting to see is that, wait a minute, those weren't all the same stocks that today were performing and underperforming, and you can see that they start to change over different periods of time. As a matter of fact, let's take a look at something in the middle, somewhere between 5 years and 1 day. Let's just go to 1 year and take a quick look there. And we can see over 1 year, information technology still leading the way, energy and consumer discretionary, and on the downside, real estate, telecom, and consumer staples. Well, we're seeing a little pattern there. So over 5 years, 1 year, we're seeing some similarities, but not so much on the 1 day or the very short term. What else do we notice? We notice that information technology seems to be at the lead in terms of sectors over all the different groups we've looked at, all the different time frames, so to speak. So you can see that over time frames, there are certain sectors that tend to outperform not just in the short term or medium, but actually in the longer term as well. So these are some of the things we want to look at when we're choosing different stocks in Jenny's portfolio, for example, and looking at different sectors and picking other stocks out of those particular sectors through the different ways that we've shown in previous episodes. Let's take even a shorter look, and let's just go to 6 months, for example, and see if anything has really changed there. Well, guess what? Information technology still leading the way. Energy has moved in. and consumer discretionary. Down below, real estate, telecom, consumer staples still seem, and utilities are all actually part of that group, are a little bit on the downside as well. So it's a great tool to be able to use to look at different sectors within the market. In addition to what the market's doing, break it down into the sectors. This gives us an idea of which sectors are outperforming and which sectors, have been a little bit weak over different time periods. Important to compare the time periods to get a bigger and shorter term picture of which sectors are performing. All right, well, that wraps up our session here today on sectors and getting an idea of the general market trend. Don't forget, for more information on these tools and other great education, visit the Education Center on tdameritrade.com. Welcome back to Virtual Trade. I'm joined by new trader Jenny Horne. Jenny, how are you?
Happy to be here again, Scott.
Okay, well, today we're going to have some fun looking at our charts, and we're going to be focusing in and identifying on trends with the stocks that are already in your portfolio and, of course, on your watch list as well.
Great, I'm excited to get started.
Okay, well, let's do this. We're going to jump into the Thinkorswim trading software. And we'll start off by pulling up your watch list, which I can see is already on the left side bar, and then loading one of the stocks right into the chart. And let's show everybody again how they can just left click on the watch list and load it right into the chart.
Okay.
So why don't you go ahead and pick a stock out of your watch list on the far left side there.
Well, I would say Lulu.
Lulu?
I love Lulu,
fine.
so I'll click on them.
All right, now let's go to the charts tab, and it should be in there.
Great, there it is.
All right, so we've got Lululemon, and let's start like we did earlier. Let's try to identify the trend of Lulu right now, and it looks to me like it's pretty obvious what the trend is here in Lulu.
Yes, recently they've been doing really well.
Mm-hmm. And again, this is a one-year chart, Jenny, one-year daily chart, so each candle represents one day. So we're getting a pretty good perspective on what Lulu has done here. But you're absolutely right. In the second half of the year, if I move my mouse here, it has definitely been on an upward trend. And of course, if we wanted to add a drawing, we can always go to drawings, change our drawing tools to a trend line. Oh, let me just move it over. And of course, we can always just click the approximate price, a year ago to where it is now. And of course, we can see that trend line definitely slopes up.
Definitely, and definitely much below the trend line until as of lately.
Okay, so tell you what, let's go ahead and get rid of that trend line. And what we're going to do now is add a study to, now that we've determined the actual trend, let's add a study to it, see if we can get a little bit more information. And what we're going to look at is a simple moving average. Now, the simple moving average is calculated by adding the closing prices of a security for a period of time and then dividing that total by the total number of time periods. Does that make sense?
It does, but I've never really used simple moving average much myself.
Right.
I know the term, but I don't really know much about it.
Okay, so the way to get to this moving average, it falls into what we call the study, right? So it's not a drawing tool, it's a study. So to go to the studies, Jenny will go ahead and click on the beaker. And since this is going to be a simple moving average, I like going to the beaker, Jenny, because if you just start typing in the name of the study, it'll bring it up for you.
Okay, great. So here I'll just type it in.
So yeah, just the word simple, and look at that, not even finishing, and there it is, number 2.
Great.
You can left click and add it, great. Apply and okay. And now we have a simple moving average.
Great, and there it is.
So what I'm going to do, Jenny, right now is hide the left side bar so we can just focus in a little bit more on the chart. Now, are you happy with the way that simple moving average looks? Or?
I kind of like these lines typically if they're thicker so you can see them better because there's a lot going on here. There's a lot of different colors. I like it to be very obvious.
All right, so if we'd like to see that simple moving average line just jump out at us a little bit more, if you will, Jenny, we can just right click on it and go to the top where it says Edit Study. And we can, right here, yeah, exactly, moving your mouse to the width of that line. And right now it's 1. So you're right, that is the small or the finest line available. But if you wanted to make that thicker, you could go to 2 or 3. It's your choice.
Great, I'll do 3 and see how it looks. Much better.
Oh, I can absolutely see that jumps out much better for our simple moving average. Now, the simple moving average, the study itself is defaulting to a 9-period segment, if you will. So in other words, just looking at the last 9 days. On our chart, that would be the last 9 days and taking an average over 9 days. Now, if that's the case, it might tend to move quite a bit. And you can see it's hugging pretty close to the way the stock moves. But if we'd like to do something with a little bit longer time frame, it might sort of smooth the line out and give us a little bit more general direction of the trend. Does that make sense?
It does. So I have a question.
Sure.
How is this different than a trend line?
Well, a trend line is going to be a straight line.
Okay.
Right? And depending on where we pick the beginning and ending points of that straight line. And a lot of times the stock can move well above or below that. Now you can see the trend line, depending on what length we use, can really hug the movement of the stock pretty closely.
Right.
So let's go to 30 days. And I think you might get an idea of what we're talking about here. So how do we do this? Well, we can go right back to that beaker again. And you can see simple moving average. That's the only study we have. And if I come over here and click on the little gear, again, that's another way to bring up the ability to edit the study. Now, you already edited the line itself. What we're going to do now is edit the length, or the inputs of length. And you can see that's a default by 9, Jenny. But let's go ahead and change that to 30, if you could. And that's going to give us a little bit different look on the simple moving average.
Oh, wait. I don't have to, I can just type that in.
Sure, you can just type in.
Oh, there we go.
30, and then we have to hit OK again, and apply an OK, and we should be good. Now take a look at that line, Jenny. It's moving, not quite as much as the stock. It's a smoother line, and gives us a little bit more idea of what a longer-term average is for this stock. And you can see that certain times it jumps well above that average, and occasionally drops just a little bit below it.
Right, so like right now, the stock is much above the simple moving average. What would that tell us?
Well, if that's a good point. People who oftentimes use technical analysis or look at charts to help them make trading or investing decisions, they'll look at this. And one of the things they look for is when the stock itself moves above the simple moving average. Now, if it moves above, as it did like here, I'll start in this case right here. You can see the stock moved above, the candle went above. And take a look at this as well. Not only are the candles of the stock moving higher, but the simple moving average is moving higher. So when they move in tandem, many people look at that as being sort of a bullish cue, if you will, or outlook for the stock.
Okay, now what if they moved in completely opposite directions? Is that possible ever?
It can be, like we can see, not necessarily opposite directions, but you might see the stock really move up quickly, and then of course the moving average will catch up with it. So you might see that. But typically, the average is, if it moves up a lot, the average will slowly start
creep up, right? Like how we're seeing as of lately in this stock.
All right, so great. Now we have a great idea of how to kind of look at moving averages for an individual stock. Now let's jump into sectors, because we've been talking about that, the sectors within your portfolio, and let's talk a little bit about what Lululemon is, and what's a quick way to find out what sector Lulu is in. Well, there's a couple different ways. I like going just to the Market Watch tab and going to Visualize, and then look at our personal watch list, and you can see, look for your individual stocks. Let's hide the left side bar. And do you see Lululemon in there? It would fall in the consumer discretionary.
They're right here, they're little.
They are little. Now that's one way. Now remember the second way, we'll go to the Analyze tab, put in Lululemon, right? And let's go ahead and look at the fundamentals and take a quick look and see if we can see it pop in here. Is Lululemon in there now?
Yes, so I think if you go to
Enter.
Overview,
All right, now
there it is.
Yep, right there. We just had it open up, and there it is. So we know it's consumer discretionary. Now, what about the trend? What if we were, we didn't have Lululemon, but we wanted to look at the sector of this particular group, the consumer discretionary group. How would we do that? Well, follow along. This is pretty simple as well. I'm going back to the Market Watch tab, and instead of looking at this, I'm going to go to the Quotes tab and then drop down to our choices here and just go down to Public, and I'm looking for S&P 500 sectors. Whoop, let me just bring it over. There we go, S&P 500 sector. All right, so let's go ahead and bring this up. Now, Jenny, what do you see? Can you find consumer discretionary in there?
I can, right at the top.
As a matter of fact, it is number one. All right, so by clicking on that, Jenny, it's linked, as you can see. So let's go to the chart. It should be right in our chart.
Great, that was so easy.
Aha, so there you go. Now we have a chart of the sector that Lululemon falls into.
Okay.
Now, what do you think of this sector?
Now this is interesting.
Kind of trending up, then sideways.
It is. It's moderately trending up now, but kind of more all over the place than our last stock.
So we can see Lulu for this sector, even though the sector's starting to move up, Lulu's been moving up actually started moving up before the sector itself.
Right, so you could say Lulu's doing better than the sector they're in.
Than the sector itself, exactly. That's a great takeaway, Jenny. So Jenny, what did you think of this lesson?
I thought this was really great, Scott, because a lot of times you hear about how a stock is outperforming a sector, and I never really knew what that meant, but this definitely gives you a better picture of that.
That's a great point, Jenny, and we'll continue to learn to use the Thinkorswim tools just in that way. Well, that wraps up our show today, Jenny. We'll look forward to seeing you next time.
Thanks, Scott.
In this episode, we learned about different types of risk that can be found in the stock market and explored ways to monitor that risk and track market trends. We also identified strategies that help manage the risks of stock investing. I'm Scott Connor, and thanks for watching Virtual Trade.